Hey everyone, this is Jeremy Miner again with the North Sound Realty Group and Anders Striemer, our special guest, talking loans. And this is part 2 of our series about the basics. And today we're going to deep dive a little bit more into FHA, a little bit more into the adjustable rate mortgages and whatnot. So thank you for joining us. So that brings me to another topic that I wanted to discuss. Now that we're moving into maybe a higher rate environment, I'm seeing more and more people looking into adjustable rate mortgages. Could you speak to what an adjustable rate mortgage is and how they're generally constructed or built?
Yeah, so an adjustable rate mortgage, abbreviated to an ARM, it's almost the Wild West. They can structure them in a lot of different ways, but the main ones that you're going to see and hear about are the 3-1, 5-1, 7-1, and 10-1 ARM. So basically, before the slash, I forget what they call that. I don't know. But the 3, 5, 7, 10, that's how many years you're going to have your rate fixed at what it is when you close. After that, it's going to adjust every month depending on what the next one is. So if it's a 5-1, after 5 years, every month after that, your rate can be subject to adjusting to whatever it is currently. And they also have parameters, though, that it can't rise too much in 1 month. So there is some protection with the adjustable rate mortgage, but there is potential that you'll see, a pretty big divide in the interest rate potentially. So especially for shorter term options, 5 to 10 years, you think you're not going to be in the home, long term. Who really buys a house and thinks they're going to be there more than a decade?
And the advantages are, and what I was kind of touching on here is that with ARMs, they'll offer you maybe a more aggressive rate up front for that, like he said, 3, 5, 7, or 10-year period, based on the fact that it's going to adjust to market rate after that. And some buyers are finding, advantageous rates in that ARM program, but you have to understand the risk as well. Another thing I wanted to talk about too, and what Anders and I were talking about off camera, FHA. What is FHA? What does that mean? So for you first-time home buyers out there, this is a really important category.
So when we were talking about conventional, a great thing to bring up specifically between that $647,200 range up to the $891,250. With an FHA loan, you can go up to the $891,250 with just 3.5% down. So if holding on to as much of your funds as possible is extremely vital, or if it just makes sense for one reason or another, FHA might be a good option even just because of assets alone.
Right.
FHA is more forgiving though with your debt to income ratio, as well as qualifying requirements, FICO score, things like that. So it's a little bit more gentle on the requirements there, but also can, on the inverse, be a little more documentation intensive.
Right.
But an FHA loan can be a great option. I think going back to expectations though, the real main thing that you're going to want to focus on when deciding which direction you're going to go, what price point you're going to be at, all those things, figuring out a comfortable monthly payment that you don't want to exceed. And that goes even further back to budgeting. And a lot of people, I find, don't have this skill really set up or well practiced in their daily lives. I would encourage everybody, even if you're not looking to buy a home right now, set up a budget for your family. There's tons of apps available for it. Even, Financial Peace University with Dave Ramsey, he has his own app called Every Dollar. But budgeting, and make sure that you're saving each month and understand how much you can save and start doing future planning. But figuring out what a comfortable payment is going to be so important because we can qualify you for way more than most people probably should be doing. Just as an example, with an FHA loan, I can do a 56% of your debt to income ratio of your gross income. So that's your income before taxes are taken out, before you pay for gas, food, insurance, health insurance, anything else. 56% of your gross income is the maximum for an FHA loan. That's a pretty huge amount of your income.
Yeah.
I mean, you start considering everything else that gets taken out. So, I mean, even in cases where I can approve you for something, I want to make sure that you're really comfortable with it because I care about my clients and I don't want you after closing to realize I can't afford this and feel like you're trapped. That would be devastating.
Yeah, both of us, really one of our most important goals is to get you set up comfortably in something that makes sense for you long term, or whatever the time frame that you have in mind is. Some of my clients come to me and they're like, well, we love the idea of a 15-year, because the 15-year mortgage might have, more advantageous rates and whatnot. But you have to keep in mind, well, your 15-year mortgage payment is going to be much higher than your 30-year mortgage payment every month. And some clients, I've literally told them, I said, well, the thing about mortgages is you can always add more to principal every month. So if you want to handle it like it's a 15-year, and then in the months where it's a little tight, you have the option to drop back down. Yeah, the rate might be not quite as good, but every little bit you're putting towards principal exponentially affects the amount of interest that you're going to pay in the life of the loan, right?
Yeah, most of the standard loans have no prepayment penalty. So that's a great point. You can always be putting additional towards your principal. One distinction that's important here, though, is if you're just doing additional principal each month, it's not going to change your payment. No. It will reduce the amount of interest you'll pay over the life of the loan because you're cutting the principal balance short. But an interesting thing that you can do is if you've built up some funds and you're not looking to refinance because rates have skyrocketed and you've got a great deal, and we're talking about someone specifically that already owns a home.
Right.
You can do what's called recasting your amortization, and you can do this typically at least one time with virtually any lender. But basically, you'll contact the servicer and you'll say you want to recast. They'll have you fill out a form, and usually they'll charge somewhere around like $250 to process the paperwork. But you'll put a lump sum, typically at least $5,000, upwards to basically any number, towards the principal. And then they recalculate your payment. Your whole amortization schedule is recalculated. And in the case of the MI, like we talked about before, if you put enough down that you're below that 80% of your original loan to value, at that same time, you can have mortgage insurance removed and everything. Yeah. So, that's an important thing to be aware of. Well, paying extra. And
this is one of the reasons why having somebody like Anders in your corner, me to a certain extent, but Anders for the financial side, because it's not like even if the loan that you've taken out and generated with Anders gets sold off and his company's no longer servicing it, he doesn't care. He's gonna, if you have a question, you call him and you're like, hey, I think I can drop the MI. What do you think? He's not gonna say, well, you know what? It's not my loan anymore, so bye. He's gonna help you. I'm going to help you when you own your home. Contractors, different resources. This is a long-term relationship that we want to work for everybody. Basically, we know that the most integrity-driven way to grow our business is making you so happy that you're sending people our way. And that's the best kind of referral anybody can get. So
I think the real secret is that we're actually in the business of making friends. And you all have been duped.
Kind of feels like that sometimes. But we care. So I think we've covered most of the major basic topics here. Actually, is there something else?
No, there's so much to cover. But let's circle back to FHA really quick.
Okay.
Because that's going to be an important distinction since we spent so much time talking about MI on conventional loans. So where FHA is different is your FICO score isn't going to affect what the MI is going to be on an FHA loan.
And it stays
MI
with
meaning
the
mortgage insurance. Yeah. So if you're putting less than 10% down, the mortgage insurance on an FHA loan will stay for the life of the loan. So you either have to refinance it, pay the loan off. It's going to be there unless you basically do one of those two things, or sell the home, which is basically the same as paying it off. The second thing is you have an upfront mortgage insurance premium with FHA. That's 1.75% of your base loan amount. And it essentially just wastes equity, which is one of the big factors as to why a conventional loan is a better option than an FHA loan.
Right.
So that's just something I wanted to bring up that was important between the two.
And that's a great comment, a great point. So as you're going through this process, let's say that, it's April and you call Anders and you're like, yeah, we want to get ready to buy a house and we're just curious. And he kind of guides you through the process of getting ready. Maybe you're not ready till fall. Well, in the meantime, you can save up and you can aim for a 5% down payment versus a 3% FHA, 3.5% FHA situation if the conventional is a better environment for you. And he's going to help you see that. He'll give you the options, help you see where the benefits and the costs are, and then you'll be able to make an educated decision, with knowledge. And that's especially the best you can do.
If you're a planner and wanting to look at things ahead of time, when it comes to credit, there's so much information that we can give you at the start that you can plan on and implement into your daily activities that will continue to help your score improve over time. So maybe you come to us thinking you need to do an FHA loan, but it takes you a year to do all the things that you really need to do to feel like you're ready. You might be in a totally different position next year, ready to do a conventional loan. You might have saved up your money. You might have improved your FICO score because of the advice that we give you. But we love to follow along the way. We're so pleased to be a part of the journey. It fulfills us.
Yeah, exactly. I mean, it's not just like you buying a house and us getting paid. We want to get you there the right way, and so that you're ready to pull the trigger when you're ready the right way and you get the right house. So I think, do you feel like we covered pretty much everything that we should cover at this point?
Yeah.
You feel good about it?
Yeah.
Okay. I really appreciate you joining us today, and I hope that you've found some nuggets of knowledge here that are going to help you through the process. And when you're ready, we're here and we're ready. So thank you for joining us. Talk to you soon.
Bye.
Bye.